Welcome to the Real Estate Show on KMED. Pete Belcaster and Joe Brett, the real estate guys, with you here on December the 30th. Welcome to the show. Hey, it's Happy New Year to you, everyone. As finished 52 shows here in 2017. If you could, well, 50 of them because we have 2 auction days we get off, you know. Anyway, moving, of course, to Sunday, 10 a.m. Remember that next week. Still at realestateshoworegon.com. The shows are always there, so you can always catch them even earlier before then if you'd like to. Anyway, welcome to the show today.
I just don't like change. It's so
I know you don't.
in my Saturday mornings, and now we get...
You don't like change, but you're going to listen to today's show, you're going to get change coming.
And that's for sure. And if the road gardener's moving with us, then I'm fine, because that's as good a local lead-in as we could get.
Well, welcome to the show today. Rick Harris and Colin Mullane are both real estate brokers here in the Rogue Valley and have been on our show before. They're both past presidents of the Rogue Valley Association of Realtors, which is sponsoring today's show. And they've also are past the work in the National Association of Realtors, and they have different positions there, as you know that. And so, welcome. First of all, fellas, welcome. I also say Rick Harris is also the owner of Coldwell Banker Pro West Real Estate in Ashland.
Hey, Pete, thanks.
Right? Nice to see you, Rick.
Nice to see you.
Happy New Year. And Colin Mullane is a broker with Full Circle in Ashland. So,
good to see you guys, too.
Anyways, I'm so glad you guys are here. We've been, we haven't seen you for a while, but boy, the rumors and all the things about this, the Tax Cuts and Jobs Act, and its effect on real estate. People have been talking about it. What in the world is going on with it? And you guys were actually behind the scenes in your positions of dealing with this while it was being made. Is that right?
That's right. So Colin and I both serve at the National Association of Realtors, who was integral to working on this tax bill for the last 2 years, 3 years as it was being formulated, and then for the past 3 months while it's really been in that conference committee and working out the final details. More than 300,000 realtors spoke out about this tax bill to Congress as it was being passed, and had a big impact on where that went.
300,000, man. That's quite a few. And what were you doing, Colin, with this as well?
Well, we've been, like Rick said, we've been monitoring this now for several years. They touched on a lot of points that the National Association of Realtors have been watching, and it really came down to a 3-month head. And one of the achievements that the National Association has had over the years is as we discuss these things with our legislators, our congressmen and women in D.C., is we remind them of the effects that some of these decisions will have on their constituents. So when they're in the room making that decision, they're remembering the conversations we had, particularly related to mortgage interest deduction or the ability to write off your capital gains on a personal residence. And those all impact the market. And when the market gets impacted, it impacts the economy and impacts their constituents. So it's really a guidance of, hey, we understand you're motivated to make these changes, but please give consideration to these factors as they could have a detrimental effect in a way that you may not be thinking about right now. But here's what our knowledge is. Here's our experience. Here's the data that supports it. So they're making an informed decision, or at least a more informed decision when these things come about versus if we weren't there at all.
So how close did mortgage interest deduction? You guys said it was on the table. How close to that? What actually ended up happening with that? Those kind of things, as we always.
So the interesting thing about any piece of legislation, it comes out on the House side, it goes to the Senate side, they go to conference committee. When it came out on the House side, there were significantly greater limitations on your ability to deduct mortgage interest, to deduct local and state property and income taxes.
This was the high tax state, low tax state debate going on.
Exactly.
Okay.
And it wasn't just high property values. California has a big problem because the median price there is much higher than it is here. Yeah. But Oregon has among the highest income tax rates in the country. And so that limitation there affects your ability to deduct what you would normally on your home mortgage. Mm-hmm. And so when the two groups got together, House and Senate working together, that's where the real effort came, because you had two significantly different bills, and the National Association was right in the midst of that conference committee working on things that are important to people. How much of your mortgage interest can you deduct? Will you preserve your capital gains preservation when you sell your primary residence? What if you're in a small business and you want to do a tax-deferred exchange? Right. All of those were essentially on the table, some to be eliminated entirely, some to be severely restricted. And what came out was some level of restriction, but way less than it could have been. And that's the action of working together on things.
So that's what you're talking about.
NAR.
Yeah. How hard is it to keep up when it gets to that conference level? There are deals made and brokered every day. And there's a lot of give and take that comes into that. How does the NAR and how do our folks stay on top of that because things move really fast and deals can be made overnight that really change the nature of the deal.
Well, I think one of the key things is the National Association of Realtors is one of the most respected lobbying bodies in Washington, D.C. because by both sides. And I mean, that's one of the reasons we're very effective is we are not in favor of an R, a D, or an I. It is very much that homeowners across the United States of America. And if you look at the makeup of the National Association of Realtors, you'll see that demographic represented 50-50, Republican, Democrat, and of course there's independents as well. But to get back to your question, they've done a really good job at hiring very professional staff who do nothing but go to the Hill on a daily basis. They are hands-on engaged with the key players in the decision factor every single day. And when there's a decision or a decision about to be made, it's an indication of the respect level that the National Association of Realtors has in that these legislators often call our staff and say, this is coming, what does it mean? As opposed, we don't always have to knock on the door and say, here's why you need to do this. A lot of times they'll call us first because they trust our place in the market, our knowledge in the market, and the impact that those decisions will have on their constituents, our members, our clients. And so professional staff, one of the great things for Rick and I, one of the luxuries, if you will, that we have is we get access to these key players at the National Association of Realtors. I can call, I can text, I can email somebody immediately after they've left the office of a congressman or a senator, maybe right before or after they go on a national TV show, and they'll tell us exactly where the ball is lying on that given day and remind us that it's going to change tomorrow and the next day. But we get a sense of how fast things are moving, how slow they might be moving, and what's at risk and what's not. So Rick and I, like I said, I personally perceive it as a luxury, is we get to see, if you will, how the sausage is made. It's not exciting for everybody, but we really get to stay on top of it and keep our members informed.
Now, even at the state level, those deals are brokered and things happen quickly when it comes down the street.
Rick said that there were changes, though, made. I mean, when you're in those positions, in it's give and take, as you say. So how did Oregon homeowners overall, we'll start with that maybe, how would you surmise that?
Yeah, so a couple of different things to think about. When they were talking about mortgage interest deduction, there was $1 million deduction on your mortgage. It was reduced to $750. It had been proposed at $500 or less. And that affects a number of property owners within the state.
That was going to do what now?
That's going to limit the amount of your mortgage interest deduction to loans of $500,000 or less.
Okay.
And so that got adjusted.
Okay, that would. Okay.
It was at $1 million. They were going to change it to $5. It got to $750. It also preserved existing mortgages. So what they've said is if you've got a mortgage today that's above that number, as long as you don't refinance it, you get to continue to deduct the amount that you did.
It's going to grandfather it in there. Okay.
So another one that was a big issue. So there's a rule that says if you earn a certain amount of capital gains tax, having lived in your house 2 out of the last 5 years, you get to eliminate that capital gain. That was on the table. It was going to be stretched out, saying that you had to live in your house at least 5 of the last 8 years. That change happened in the last several days of the bill, and they preserved the existing.
They did preserve the 2 years now. So
2 years out of the last 5.
We have a lot of investors who listen. So explain that to them just quickly one more time for them.
So in order to deduct the capital gain that you might earn on a house. Income earned above what you paid and other investments in it, you have to live in a house, physically occupy it 2 out of the last 5 years. That was going to be changed to 5 out of the last 8 years.
Well, and that would have a huge impact.
What essentially it would do is take a limited inventory market and say, nope, you got to stay in your house even longer. And that limited inventory, what we'll see when we talk about our market, that limited inventory is what's been driving prices up as strongly as it has, and it's not getting any better.
Yeah, wow.
Also affects that 500, 750 threshold you talked about with the rising market values we've had in the rebound the last few years.
Exactly right. And then you lay that against things like the amount of property taxes we pay, and in a high income tax state like Oregon, there is an absolute limitation, $10,000 for state and local taxes, income and property taxes. And for Oregon, with such a high rate, we're over 10% on our income tax. That negates much of the property tax that homeowners might get to.
All right. Fellas, is that the biggest impact on the homeowners? Is just what you've said right there on us? Is that?
I think that Rick touched on for what I always felt was one of the biggest issues, which was the capital gains exemption. And Rick's pointed to the supply side. And the reason that's up, if you think of this, life happens. There are military families who move regularly, and if they've owned a home for 2 years under the current rules, and they needed to move, they were required to move. Or any job, there are doctors that don't stay in positions for very long just based on contract. There are lots of different jobs and mobility issues where people will want to buy a home and have to move for one reason or another. And if that 5 of 8 year rule came into play, people either one would have to take a massive hit. So if you had a $100,000 gain, which is a lot of money, but it's a lot of money to people that it really means a lot to.
Right.
And so all of a sudden you make a $100,000 gain and you have to pay a $30,000 tax that you didn't have to previously. A lot of times people will say, I'm just not going to sell it then. I'm just going to wait for that 5 year, and I'm not going to make a move. I'll turn down the job offer, and they will deny themselves the opportunity to move up in society, move up in the economy, make moves. So that to me was a very, very big one. The mortgage interest deduction victory at the $750 was important. It's important for a couple of reasons. It's important because it acknowledges the importance of home ownership as it still exists as part of the American dream and in this country, something I really strongly believe in. Remember, I wasn't born in this country. I moved here. I called my parents at the age of 27 years of age and told them that I owned my first home, and they thought, how did you do that? Who did you rob from? And I said, it's actually possible here. It's something that's not possible where I come from in Ireland. And it's a luxury that we get and that we fight for as realtors every single day. We are only one of 2 countries in the world with a 30-year mortgage that allows for that. So these are pieces that are enshrined in what it means to be an American, what it means to live the American dream. And so the National Association of Realtors is very, very mindful of that. So we go out every single day and we fight for it, and it's meaningful. It's a good fight.
Well, you obviously are successful at it, because I thought that was pretty draconian, the 5 out of 8 years. I thought that was...
Well,
but anyway.
and understand that came in 1986 in the previous tax bill with Reagan, and hadn't had that before. At that time, there was what they called the one-time golden years exclusion, $125,000 one time ever. And so it was a big adjustment when Reagan did it. But understand that when people buy a home, they're making a contract. They're making a contract with the government for a certain amount of mortgage interest deduction, deductibility of taxes and property taxes and income taxes, because that comes together in the whole of how they make their consideration to buy. And what people may not understand is that mortgage interest deduction was enshrined in 1913. When the first income tax happened in the United States. So that's a 100-year contract with the American public that Congress was then in the midst of making major adjustments to. And it's hard to do that when home ownership is a long-term investment, not a short-term investment.
Yeah, and so you said that was the first change.
Not the first one, but the first major
change.
Yeah, exactly.
Well, see, so go back again. So if people say this 10,000 cap, okay? So we know right now that $750,000 is the loan limit that you'll be able to deduct anything below that.
Right.
Correct. So, so that goes to what? High earners are going to be able to go above that, I guess, and they could probably afford that. You think?
Well, let's think about that.
All right.
So let's say that you have a mortgage of $150,000, and we'll take a little bit higher than normal number, but let's say that that's at 6%.
Okay.
That monthly interest on that over the course of a year is almost $11,000. That's before you deduct any local income taxes. So you can see that the combination of not a terribly high loan and not a terribly high income level combined together, the property tax limitation, the limitation on mortgage interest deduction, the two together trade off and make that much more limiting on home ownership. And we've talked many times before, Colin and I, about the idea that home ownership is what makes community.
Absolutely.
And everybody who's ever rented and wanted to be a homeowner has said, I'm going to invest in myself and my family the ability to own my own home, to invest in myself, to have a capital formation engine. And that gets severely limited. We'll see how the trade-off, because there is a trade-off here, of the doubling of the standard deduction works, because that's the trade-off that they had to get to. And part of the reason that we fight so hard on these issues is that we also understand that homeownership is what makes it possible for the average American to have enough income, enough stability to be regular taxpayers.
And how many times have we said the home ownership, the average, it creates wealth for millions and millions of people versus the renter. I mean, that whole thing is, I mean, the amount of money difference is shocking.
It's a cornerstone of retirement and something you can pass on as well generationally.
And the thing I want to say as well is if you ask the average renter, would they prefer to own or to rent? Almost all would prefer to own. to be in control of their own environment, their own capital formation, their own family situation, rather than be at the mercy of a landlord.
Absolutely.
And
yeah.
so that's only possible when you incentivize that through things like the mortgage interest deduction, like the deductibility of
Do you fellas think
property
that
taxes.
as a result of all this, that the market, is it going to have an effect? Obviously, it has an effect on everybody in some way or another. What do you think it's going to do to the real estate market overall? I'm sure that was talked about in your meetings and all your things, your stuff like that.
I think that, ultimately NAR worked as hard as they did to get the outcomes that they got in order to not interfere with the market. I don't see anything in front of me right now that says this is going to have a dramatic effect on the market.
Yeah.
I think that they were successful with that, and I think the market will continue to grow and do what it's going to do based on that effort. I mean, and it was huge.
Hold those thoughts. We got more. We got a break coming up here. I agree with you, Colin. It's that's a good sign as well, as the market certainly is robust, certainly in Southern Oregon. We've got a break coming up. The Real Estate Show. We're with Rick Harris and Colin Mullane. We'll continue here on KMED right after this. The Real Estate Show rolls on here on KMED. December the 30th is our date. Pete and Joe, the real estate guys, with you here today. And Happy New Year to you, everyone. Our final show of 2017 is move on to another year. I guess we're supposed to be a year wiser out of all this, is what I've always been told. Well, we'll see if that happens. That with the rate I'm going, I should be really smart by now. Rick, I should be, right?
I think you have some catching up to do, Pete.
A lot of that. Anyway, Rick Harris and Colin Mullane are with us here today on the Real Estate Show. They're both past presidents of the Oregon Association of Realtors and high ups in the National Association as well. They've been involved with the recent lobbying with the Tax Cuts and Jobs Act, and we're talking about that today here on the show. We talked about the mortgage interest deduction, that $10,000 limit. That seems to me to have a big effect on everybody, Joe, because you should pay $4,000 in property tax, and we've seen them a lot higher than that. I mean, and then if you have a job, and we have a high income tax state, you're going to see a change there. You're going to see that. And I know that Glenn Cunningham, will be with us later, next year, and talk about the tax effects on all this as well. But I do want to ask you fellows about investing, because we've got lots of investors. A lot of people own property, own investment property. How did that fare? I would think that would be an easy target too in trying to maybe change the rules there. So what happened with investors?
Well, one of the really, really interesting things that NAR was able to succeed at was stopping the idea that we ought to tax rental income.
Rental income.
Exactly right. So that they were looking to make, the House bill looked to make rental income taxable as an individual tax rather than as an investment tax.
Ooh.
And so they were able to push back successfully on that particular issue. And then one that many investors use with tax deferred or like-kind exchanges. And
you're talking 1031 exchanges.
1031 like-kind exchanges, that's right. And so there was a lot of effort to try to limit those, or in fact, by the head of the House tax writing committee wanted to eliminate tax-deferred exchanges for real estate entirely.
Altogether.
So NAR worked very effectively to limit that activity, and in fact, tax-deferred exchanges are preserved as people have come to expect them.
That would have been a big change, wouldn't it?
Would have been.
Now, there was one change that wasn't there because Esther Auerbach from Old Republic was here a few weeks ago, and but wasn't there an exchange that the 1031 personal property exchange was eliminated, right, out of that thing or something?
Yeah, that's correct. So from the real estate side, you're always exchanging real property for real property.
Right.
And the 1031 code actually allowed personal property to be exchanged, art, as an example. That was eliminated. So now 1031 tax deferred exchange are real property for real property only.
Which is what it should be used for, in my opinion. So I think that's probably maybe a good thing. It was designed for property exchanges, right?
Exactly.
And changes out of that. What else is that? What else is in there that you fellas, were involved with that you think people need to know?
Well, I think the 1031 piece is probably the largest piece. I think people underestimate just how effective that is in our economy with regards to people transferring property. So if you are, let's say, for example, you own 10 rentals in Medford, but you live in Ashland, you're getting a little bit older, you don't want to do the drive every day because that's what you do. Maybe you don't use a different company to do it. And you want to say, I'd rather have 5 or 6 investment properties in Ashland. And so you want to sell the ones in Medford. And the 1031 exchange says, I'm going to sell them. I'm not going to tap into any of the the income I'm getting from that, but I'm going to use those monies entirely to make the purchases in Ashland. So 1031 exchange is basically acknowledging that the owner is making an investment decision that allows them to move from one asset to the other without taking any of the equity out of it and allowing it to perform at the same level, hopefully, in the new market. So that does happen quite a bit. And maybe a better example of that would be somebody moving here from the Bay Area to the Rogue Valley who wants to own investment properties. And so the freedom to be able to do that and not face the income penalty is significant. Corporations also do it. They buy massive buildings. So if you are a Google or a Facebook and you own a massive warehouse, maybe in the middle of Oregon, and they do, and they want to move to a different location, they want to be able to sell that and use all of the monies to purchase the new one. They're not trying to make money on it. They're just trying to make a lateral move or a move that's better for them or maybe better for the community. And so to penalize them unnecessarily holds that investment in a place that may not be performing at its best. And remember, the key piece is it's a tax-deferred exchange.
Right.
At the time that somebody sells it to tap into that equity or take the gain, the taxes are paid. The government is made whole. But in the meantime, that person's hard work and effort is allowed to continue to gain and do the most amount of work at the best value of return for that person.
And even a corporation, you say Google can do that same thing. Large companies can do it 1031 exchanges too. I didn't really know that. I didn't realize that as well. All right.
You know, there's another piece about the capital gains that I think is important for investors. So the question is, when do you get capital gains treatment? So you'll want to be able to talk to your tax person because the rule has been a little bit vague. Do you have to own it for 1 year? Do you own it for 2 years? It's very clear in the new bill. In order to do that, in order to get capital gains treatment, you have to own it for 3 years. Then you get capital gains treatment on that capital gain. Now, do talk to your tax person so that you understand if you've exchanged it, that may adjust that time frame. So, but that is an adjustment that people will want to know about and talk about.
3 years. 3 years.
Before you
And what was it? What was it before? Was there anything? There was nothing on it before.
It was always one of those pieces where you say, "Well, do I get it after 1 year? Do I get it after 18 months? Do I get it after 24 months?" And depending upon the circumstances, it may have adjusted in that particular piece.
So do you either, Colin or Rick, do you see a change or a slowdown in that activity as a result of any of this in the market?
I don't necessarily think so. I think investment property purchases don't tend to be impulsive. They're there for a long play. And so you don't see a lot of investors that are going to go buy a 10-plex and want to sell it 16 months later. They don't flip 10-plexes. You just don't do it. So they're buying it. They typically hold on to it for decades, frankly.
If you're investing with it, you'd want to do that.
Well, you're looking for income, and the income comes from the long-term hold is what I was talking about. Yeah. And so I think the idea that you flip it very quickly, that only works in a rising market when you've got something that you can significantly add value to. And the typical investment at this point, you're buying it for income.
Right. Were there any incentives put into the bill or anything for homeowners at all?
We really were on defense on this one.
So you didn't even have an offer.
We are one of the things that the National Association of Realtors has reminded all of us. I mean, Pete and Joe, you're both realtors. You get the calls for action. You see the emails, and people wonder, why do I get these? Why do I get? I got one last month. I got one the month before. And I think to Rick's earlier point, what's really important and what we need to educate our members and maybe the public as well is the reason that happens is the first bill comes out of the House. We tell the House, this is why it's important. This is what you got to do. And then it goes to the Senate. Then we got to tell this is what's important. This is what it's going to do. So as it changes, we've got to keep inviting ourselves back to the table to tell them where it is now. And is it perfect yet? Is it good yet? Are you happy yet? And we need to remind them yes or no or not. There are several elements of this bill that we will continue to work on as they refine the language. As one of the things that they'll do over the next 6 to 12 months going forward is we'll be able to highlight some of the issues we warned them were going to happen as they happen and say, you really need to work on this. This one piece is holding this part of the market back or affecting your constituent in this way, and it's damaging the economy. And so there's still a lot of work to be done. By no means are we done at this point.
So you still keep that going.
Well, and the other part of it is that when a law is passed, that's not really how it gets implemented. Then you have to go to the federal agencies
they write the rules.
Going to write the rules. And one of the great things about NAR, while it has political lobbyists working with Congress, it also has an extensive staff working with federal agencies, working with the IRS, working with the HUD, working with the FCFC, or excuse me, the Federal Housing Administration, and so on. And that's where they can make significant difference in the actual implementation of the law. And so NAR doesn't look at it as just what did we get in this political side of it. Now what do we get at the administrative side of it, and the rulemaking side. So the job, as Colin said, is long-term and one to be continued.
Do our lobbyists ever ask the government to do better with what they have already and not attack the tenets of American home ownership, which are the mainstay of our country's economy and our dream and our promise to citizens?
I think the National Association of Realtors is widely acknowledged as having that responsibility and that request as soon as they walk in the room. Because they know that.
At the state level as well, we just all the time, industries, businesses under attack. They're after more and more revenue, and gosh, they have enough already, it seems like. And there's a tipping point where you just can't sustain that any further.
Well, government loves money, that's for sure. I want to tell folks that the Tax Cuts and Jobs from the NAR, their synopsis, they're part of the bill there. We have it at realestateshoworegon.com. It's 42 pages, but it's actually pretty cool. It's got a lot of graphs and charts. You might want to go there and check that out. Coming up next with Rick and Colin here, we're going to talk about the market here in Jackson, Josephine County. We just finished in 2017. It was one heck of a real estate year. We'll get their prognostication for next year. A little bit more when the Real Estate Show continues here in KMED right after this. The Real Estate Show rolls along here on December the 30th. Pete Belcastro with you here in KMED. Happy New Year to you, everyone. Hope you have a safe New Year's Eve tomorrow and enjoy New Year's Day as well. And we'll be back with you next Sunday at 10 a.m. here. Don't forget, you can check out any of our past shows at realestateshoworegon.com. Lots of great shows there, lots of good information about our real estate market. And speaking about our market, today our guest, Rick Harris, is the owner of Colwell Banker Pro West Real Estate in Ashland and the past president of the Rogue Valley Association of Realtors and OAR, Oregon Association. The same thing with Colin Mullane from Full Circle. Well, fellas, first of all, your information on the tax bill and all that is really interesting, and I can't even imagine how you guys got to really like that nitty-gritty detail stuff for home ownership, and so that's really cool. Now, so we'll go on to something else, because the market, I mean, I'm so curious as to what your impressions of 2017 were like, and what you think next year is going to be, because the demand is certainly not going away, at least from what I see.
Yeah.
And interest rates honestly are lower than they were a year ago, if you can believe that. After the election, they went up a bit, and they were actually lower than they were a year ago. So that's a good sign.
Right.
So beyond that, tell us what you thought of this last year, because values are rising, and I'm just curious as to what you boys think.
Well, I think one of the things my wife reminds me when we get caught up in the nitty-gritty of the stuff we talked about earlier is you still got to get up every day and sell houses. That's our job. This is what we get paid for. So,
that's right.
2017 was consistent with the year before in terms of a similar level of demand, similar levels of supply. Interest rates were fairly consistent. I think statistics bear that out. I think one of the challenges when you speak to individual realtors is you're just getting their specific tale on a given day, which can vary from one to another, and you don't really get a sense of the market. But it's really been strong. It seems to me personally, and this would be anecdotal, that I have as many buyers coming into the market for 18 at this time, maybe even more than I did last year. I think one of the most interesting things of the market, and this is a general statement for me, is just how better informed consumers are coming to the market.
Oh, yeah.
They're demanding more from their realtor, and they should. We're bringing more to the table for them, and we should. And I think 18 will be another good example of that in terms of buyers in a very competitive market having high expectations on what our role is in a transaction, and again should be. Some of the toughest things for consumers are coming into a market where they're dealing with multiple offers and the disappointment that goes with that, and what's realistic, and whether I should do this and whether I should not. And Pete, you know this, a large part of our job is counseling in that regard. And there is no absolutes. I don't think any agent in this valley can put their hand up and say, I'm always right all the time, because every single circumstance, every single transaction is different. And experience brings a lot to the table in terms of what a client can expect.
Absolutely. Rick, what do you think?
Pete, I've been at this almost 30 years. And I was struck by a statistic that I think is really interesting. Last year early is the point at which values returned to the 2006 levels.
Okay.
So we went through the really highs of the early 2000s, the really great recession, and very early this year we got back
to
at that level. So we essentially took 10 years of normal growth out of the market, and we got past that, and we've had increases since that. So if you look at the 5 years ago, the prices are up 25% since they were 5 years ago. But where were we 5 years ago in 2012? Really just almost at the depth.
Yeah, it
the
was
market.
pretty low then.
And so we've worked our way through that. But some things have come out of that. People are staying in their houses longer.
Yes.
And interest rates are incredibly low. But what interest rates being incredibly low have done is allowed prices to rise. So prices are higher. Interest rates are low. People are staying in their houses longer. Inventory is incredibly low. And as Colin points out, that makes for a very challenging environment for a consumer to work in. So they say to their realtor, I need you to help me navigate this. I need you to help me understand the intricacies of the market, the intricacies of negotiation in your market. What are good values? 65% of the people who come to the Rogue Valley come from California, and they have a really different market than ours.
Well, yeah.
When you have a median price in Ashland in the mid fours, that's really a low number if you're moving from Marin County or Southern California. And so the thing that the consumer really needs that they can't easily get is that local market expertise. And that's what Colin's talking about is being asked of us, and it should be. That's the place where we really can shine. So I continue to see the value of the realtor in the transaction, but it is challenging all of us in the business to do a better job, a more thorough job, a more informed job, and to treat the consumer with the level of respect that we each would like ourselves.
Because certainly consumers, as you say, Colin, they're very aware of what's out there, and they've looked and they've searched, and very few people say, I want to go buy something and start from zero, do they? I mean, that's not the way it is. The whole business is changing, like everything, isn't it? Everything. Technology continues to do crazy things as well.
Well, and the interesting thing for the consumer is they're exposed to all of the information. They don't yet know how to say that's good information or bad, and that's where we come in, because we all have those conversations where they've read online that a property is worth X, Y, and Z, and they take it as verbatim, and it's absolutely accurate. And so part of our conversation is to educate them into what our market really looks like, whether that really is a good value or not, to help them. So not all information is good. And that's what our role is to help separate all of the data they expose themselves to and say, this is what you can trust, and this is maybe what you need to look at a little harder and maybe not rely on it quite so much.
Do you fellas, as we go into 2018, what would you like to see? I mean, I'd like to see more alternative housing. I'd like to see be able to easier to put a second home or second, tiny house on a big lot, things like that. That would help our housing crunch, because that seems to be the biggest problem. We don't have enough places for everybody.
Well, and the thing I'd say about that, Pete, Ashland just passed essentially a small auxiliary dwelling ordinance within town, make it easier for you to put in any zone an auxiliary dwelling and make that an easier pace. On the flip side of it, when you try to bring new land, new inventory into the city limits to be able to build on, incredibly difficult. And so I think that we have this environment in Oregon that we love the beauty, we love the open spaces, but we trade it off against our ability to meet a growing population, meeting a need for a variety of kinds of housing. Different kinds of laws that came about over the course of the past legislative session. We worked really hard this year about issues about rent control and what that might mean to people making investment in multifamily housing where there'd be more options. So I continue to see it being a struggle in the long term, that we balance the lifestyle that we love with the need to supply housing and opportunity for people who like and want to be here.
I think that hits the nail right on the head, Rick. I mean, that's exactly what we do here, isn't it?
It surely is.
The demand isn't going to go away because our secret is out, isn't it? People want to come here, and the housing market reflects that. Rick Harris and Colin Mullane, thank you so much for being here, fellas.
Thanks,
Happy
Pete.
New Year to you
Thank
as
you.
well. And thank you for your hard work on behalf of homeowners across the country. That'll do it for the Real Estate Show. Happy New Year to you, everybody. God bless you all. We'll see you next Sunday back here on KMED.
You've been listening to The Real Estate Show on KMED Radio, presented by the Rogue Valley Association of Realtors, along with John L. Scott Real Estate of Southern Oregon and Bank 34 Mortgage. For guest contact information, download our free app, or to watch a past show, visit us online at realestateshoworegon.com. This show is produced by Table Rock Productions. Join us again next weekend for Southern Oregon's one and only Real Estate Show on KMED. And thank you for making The Real Estate Show part of your weekend.